Okay, hi there. Welcome to another video. This time we're going to spend a little bit of time thinking evaluatively about the arguments for and against a country running a free-floating exchange rate. So a free float is where the external value of a country's currency depends wholly on the market forces of currency supply and currency demand. And there's no central bank intervention, either through direct buying and selling or changes in interest rates. The exchange rate is not a target of monetary policy. Effectively, a country allows the currency to find its own market-determined level. And good examples, both the UK sterling and the euro are both free-floating exchange rates. The pound, the UK, has had a free-floating currency since we left the European Union exchange rate mechanism nearly 30 years ago. So just thinking evaluatively, what are some of the advantages of a country choosing to operate a free-floating currency? Well, there's lots of points you could make. Here are three that might be worthwhile adding to your revision notes. First of all, free-floating currency can provide, in theory, a partial automatic adjustment if a country is running a sizable trade or current account deficit. You see, if there's a trade deficit, for example, that's a net outflow of currency from a country because the value of imports is greater than the value of exports. And other things being the same, ceteris paribus, an external trade deficit will lead to a currency depreciation. It's not always the case, by the way, because many factors affect the exchange rate. But if there's a net outflow of currency, that tends to cause a currency depreciation. That then leads to expenditure switching effects. What we mean by that is the relative price of exports overseas goes down, the domestic price of imports goes up, and in theory, that might improve the trade balance over time. You'd need to link that to your notes on the J-curve and the Marshall learned condition. The second point, I think, is perhaps, the most important. A floating exchange rate can be a very useful absorber, a macro shock absorber when there is an economic shock or disturbance that hits the economy. So one thinks about recessions and things that often come about because of external factors. Think about the global financial crisis, for example, or the pandemic. If there's a recession that hits a country, and it could well lead to a fall in exports, but a general recession, the currency often depreciates. It goes down in value. The currency traders mark the currency down. Now, a fall in the currency is equivalent to an expansion of monetary policy. It does help to stimulate and lift aggregate demand. Particularly, it gives a lift to export industries. So if you get a recession and your currency falls by, let's say, 5, 10, 15%, that can help restore export demand. Obviously, it depends on what's happening to growth and demand in other countries as well. But a couple of examples, the pound fell quite sharply during the global financial crisis. Would the recession have been worse had it not? The Polish currency fell sharply in 2008, 2009. There's Zloty. And in fact, Poland avoided pretty much a recession during that period, partly because they had a very super competitive currency. The third argument for free floating is that if you allow the currency to find its own level, then the central bank does not need to hold big, extensive foreign exchange reserves of gold and dollars and euros and yen, etc. Because they don't have a specific currency target, they don't have to intervene in the markets. Now, for some countries, they don't have those big foreign currency reserves, particularly low and middle income countries, and therefore a floating exchange rate takes away that requirement. And also with a floating exchange rate, you don't have to block or put barriers to the flow of capital across borders, because of course capital flows, portfolio flows, hot money, they can drive the currency up and down. Well, if you're not too worried about the exchange rate's value, capital can flow freely across borders, so that might make a country more attractive to investment. However, of course, as with everything in economics, there are potential risks and drawbacks as well. If you allow the currency to find its own level, you're taking away one possible instrument of macroeconomic policy. So it removes the option essentially for a government via the central bank in a fixed exchange rate system to manipulate the currency to achieve a competitive devaluation and thereby improve their cost and price competitiveness. So some countries deliberately moved either to managed floating or semi-fixed exchange rates because they want the exchange rate to move in a particular direction, perhaps to stimulate their domestic economy or their export sectors. Free floating exchange rate, that is not an option. Second point, a free floating currency may be volatile, unpredictable, uncertain. Now, if you have a volatile currency, that could inhibit trade and it might also inhibit long-run investment. You see, a volatile currency increases the risks for overseas investors that their money might lose value when the domestic currency falls in value against other currencies. And linked to that, point 3, you can almost put point 3 or point 2 together, I guess. Floating currencies might invite more currency speculation because there's more movement in price, there's more opportunity for arbitrage and buying and selling to take advantage of the price movements. And often a currency might move a long way from what is suitable for the domestic economy. It might be too strong, risking, deflation. It might be too weak, risking inflation. So there we go. Some evaluation perspectives. The impact of a floating exchange rate depends on how open an economy is to trade and investment. Nice little contrast here. UK is a fairly open economy. If you add together the value of exports and imports, it comes to about 65-70% of GDP. We have a free floating exchange rate. Singapore has, I think, the highest trade to GDP ratio of any country. It's certainly well above 300%. It might be even getting close to 400%. Now, in that situation, because they are so trade-centred as a nation, they have decided that monetary policy must centre, the focus of monetary policy must be on the exchange rate. So they've gone for a managed float, not just against one currency like the dollar, but against a basket of currencies, against of major trading partners and competitors. So China will be there, wouldn't it? Japan, the UK, Australia, New Zealand, and the United States, and the euro, of course. So Singapore has gone for managed floating, which is kind of halfway house, a hybrid system, where the central bank does look to manage the exchange rate in a particular direction. Third point, there's often speculative activity against fixed exchange rates too. So speculators will target the currencies they perceive to be the weakest, really. And that can happen with fixed exchange rates too, particularly if you think there's going to be a devaluation. And also, we said that floating currencies might be volatile, but they don't have to be volatile. Sterling is a floating currency. It goes up and down, but sometimes it has periods of stability. And if you're an overseas investor, the yields on bonds are pretty low. There's limited currency risk, even though we have a floating exchange rate. Fundamentally, the British government's never missed a repayment on its debt. So that's a factor that brings risk down for overseas investors. The currency risk is part of the story, but it's not the whole point. And crucially and critically to finish with, yes, the exchange rate does affect the price of exports and imports and trade, but we know, of course, in the world economy that non-price factors, quality, design, branding, etc., often drive trade flows. And in a sense, if the non-price factors dominate in oligopolistic markets, that can make the external value of exchange rate less significant, less important for the external trade balance. Okay, there we go. A quick look at the arguments for and against free floating. In a future video coming up soon, we'll look at the arguments for and against fixing the exchange rate. Take care. See you soon.